Welcome to Stock Spotlight. I'm your host, Michael, and in each episode, we'll dive deep into the stock market, analyzing companies that have scored either a watch or a pass on my 33-question checklist. Since this is our inaugural episode, we'll deviate a bit from our usual format. Instead of analyzing a new stock, we'll cover 4 key areas today. 1, my background and journey in investing. 2, my investment philosophy and current portfolio structure. 3, my investment checklist and database. And 4, the format and flow of future episodes. By the end of this episode, you'll have a clear understanding of who I am, how I approach investing, and what you can expect from Stock Spotlight moving forward. So let's get started. I'd first like to talk a little bit about my background and journey. I'll talk about 2 things. 1, my family influence on investing, and 2, my analytical approach to investing. Well, my investment journey began with strong influences from my family. My grandfather was an avid Wall Street Journal reader, which sparked my family's interest in stocks, and I often wish I could have discussed investing with him before he passed while I was in college. My father was a senior executive in industrial manufacturing, and he also built an investment portfolio that inspired me. With a business degree and a high savings rate, I have successfully built a portfolio exceeding $500,000 when you exclude IRAs. Now, a little bit more about my analytical approach to investing. My background actually began as a starting pitcher in competitive baseball for 2 decades. This experience, combined with my statistics knowledge, has shaped my data-driven approach to investing. I apply the same rigorous analysis to my investment strategies as I did to improve my pitching performance on the field, focusing on key metrics and future performance potential. I'd next like to talk about my investing philosophy and my current portfolio structure. My investment journey has evolved over time, leading to a diversified approach that combines traditional and alternative strategies. So from a traditional standpoint, I do have the S&P 500 index funds as the basis of my portfolio. It's right now around 25%. I started with the widely recommended approach of investing in index funds, specifically the S&P 500. So this still forms a significant portion of my portfolio. Next, I have about 25% of my portfolio in factor investing. As I expanded my knowledge, I incorporated factor investing into my strategy. I may talk a little bit more about factor investing in a future episode, but factor investing aims to enhance returns compared to traditional market cap weighted approaches by targeting specific drivers of risk and return, such as value, momentum, size, quality, and volatility. About half of my total factor investing percentage of portfolio is comprised of international ETFs. So that's really where I get my international exposures, through the factor investing ETFs. I also have around 15% of my portfolio currently in managed futures, and I'd like to aim for 25 to 30% long term. This is my most recent addition, and it's become more accessible to retail investors through new ETFs in the last few years. Managed futures includes actively trading futures contracts across various global markets, including equities, commodities, and currencies. They offer strong portfolio diversification due to their typically low correlation with traditional assets, and they aim to capitalize on price trends and market inefficiencies while potentially providing positive future expected returns. I'm looking to increase my allocation in this area over time, and I'm currently in the ETFs DBMF and KMLM. I also have around 35% of my portfolio in individual stocks. After exploring managed futures, I've now ventured into the individual stock realm, and I have 20 holdings in my portfolio. My strategy here is to aim for a few very large gains while minimizing significant losses. To achieve this, I focus on building large position sizes in companies that I think are the highest quality and offer the best potential for 30 to 50-year risk-adjusted returns. I also keep my potential losers small, which means selling early in some cases, and I understand that significant portfolio impact comes from larger positions. I'd now also like to talk a little bit about my stock strategy, which is a quality growth investment strategy. So that is my preferred approach, and I define owning high quality businesses that demonstrate diversified revenue streams across multiple business segments and geographical regions with proven resilience to economic fluctuations. A quality growth company also has high earnings and free cash flow per share growth. They reinvest capital at high rates of return, maintain little to no debt, have high gross and SBC, stock-based compensation, adjusted free cash flow margins. And lastly, I've got that they possess a distinct competitive advantage or a market leadership position. I also believe that quality investing is one of the best methods for a buy and hold strategy. Two other points on quality growth investing. I intend to maintain a concentrated portfolio of 15 to 25 companies. As I mentioned, I'm currently at 20 companies, strategically selected based on my assessment of the best long-term investment opportunities. I also believe in having a bench of 5 to 15 names for your watch list. These names must earn or beat their way into core positions. The last thing I'll talk about with my portfolio is cash. So I currently have about 4 to 5% of my portfolio in cash, split between a money market fund for stability and modest returns, and a cash account for opportunistic buying within the next 6 to 12 months. I'd next like to just touch briefly on my valuation thoughts. My view on valuation is that its importance increases as your investment horizon shortens. For long-term investments, thinking 30 to 50 years, the performance of the underlying business tends to outweigh the initial purchase price in importance. My preferred valuation for my portfolio is the forward free cash flow yield. Now, I don't typically, and I will not typically report this on my stock episodes because it does take a little bit of time to do this and it requires some Excel calculations. But the forward free cash flow yield is calculated by dividing a projected 5-year future free cash flow per share number by the current share price. This gives you a yield. This approach combines growth and valuation in one metric with a forward-looking perspective on a company's potential return relative to its current market value. When analyzing new stocks, I typically most prefer doing a reverse discounted cash flow analysis in combination with a traditional DCF analysis, while also comparing the company to itself historically on key valuation multiples such as enterprise value to EBIT, which is EV to EBIT, and enterprise value to revenue, which is EV to revenue. This approach allows me to rather quickly assess a company's performance both in relation to its historical data and against industry benchmarks, providing a comprehensive understanding of its relative value. I'd next like to talk about my investment checklist and database. I have a 33-question checklist that evaluates companies across 9 categories, including fundamentals, management quality, industry position, fundamental and technical momentum, historical and future growth, valuation, capital allocation, and solvency and liquidity. By examining these diverse aspects, we aim to gain a holistic understanding of a company's strengths, weaknesses, and potential as an investment opportunity. So far, I've screened 191 stocks across 9 different sectors with a mean quality score of 58%, a standard deviation of 15%, and a top quartile benchmark of 70%. I also just like to look at company size distribution of those companies I've analyzed. 83% of the companies I've analyzed would be qualified as a large cap company, which is 10 billion or more in market capitalization. 16% as a mid cap, which is 2 to 10 billion in valuation. And small caps 1%, which is 250 million to 2 billion in market capitalization. From a sector distribution standpoint, 20% of the stocks I've evaluated are in consumer discretionary, which is the number one sector, followed by 18% information technology, 16% industrials, 13% healthcare, 9% consumer staples, 6% financials, and then 5% for energy, materials, and communication services. For each episode, I will then talk about an overall stock evaluation. The stock will be given a quality score, a percentile, a status, which is either pass or watch, a Schwab rating that we'd like to integrate as well, and then also a Guru Focus score along with a Guru Focus percentile from my database. I'd now like to talk about the format and flow of future episodes. My goal is to produce at least one monthly 25 to 30 minute deep dive into a quality company. In the future, I might go beyond quality company screening to talk more about my investment philosophy, integrate beginner Q&As, etc. But for now, I will focus on dives. How the deep dive will work. So there'll be a quick 3 to 5 minute introduction. There'll be a 1 to 2 minute overview of the checklist and database updates. There will then be 3 to 5 minutes on the business overview and another 3 to 5 minutes on the business model and what I've deemed are the company's high quality attributes. This will then be followed by a couple minutes talking about growth opportunities and risk factors. And then we'll get into a very brief high level financial statement overview, some discussion around management, their company's ownership structure, and we'll finish with valuation and just a touch of technical analysis. And I'll then conclude the episode takeaways. And if the podcast does get popular enough, I would like to leave time at the end for listener Q&A. And that wraps up our inaugural episode of Stock Spotlight. I hope you found this introduction insightful and valuable. We've covered my background in investing, my investing philosophy, and what you can expect from future episodes as we dive into companies that have scored either a watch or a pass rating on my 33-question checklist. If you enjoyed today's episode, please subscribe, leave a rating, or drop a comment. Your feedback helps us grow. For real-time updates and insights, follow me on Twitter, X, at Invest091. Join me tomorrow as we analyze our first company, Rollins Incorporated, ticker symbol ROL, using the format we discussed today. Till then, keep your investments smart.